And we're back with another episode of Pure Perspectives. I am pleased to be joined by Gary Pierce again. How you doing, Gary?
Fantastic. How pleased are you, though? Really? I mean,
Well, are we going to do that on a scale of 1 to 10? I mean, it depends on the answers you have for my questions, because today we're talking about the market update. And there's a lot of people with a lot of questions about what's going on, what they can expect in the coming weeks and months with respect to interest rates. So, what say you, Gary, on what are the leading indicators that people should be paying attention to when they are tracking or trying to predict which direction interest rates will go? That will determine my satisfaction with the session.
Okay. Well, with all that, you can probably guarantee yourself hitting the Powerball if you can figure out where rates are going to go. I mean, seriously, between, obviously we've got, I don't know, 5 things, right? Recession, tariffs, the 30-year, the 10-year, and inflation. Those are probably your 5 top drivers. We battled inflation. That was the big thing that drove rates up back in, where are we? 22, 23-ish, right?
Yep.
Inflation goes at 8.5, 9, whatever it was. Chipped away at that, brought it down. When inflation goes up, so does the 10-year. So if you're into the markets and you understand Treasury bonds and those kind of things, 10-year goes up, our mortgage rates go up. 10-year comes down, our mortgage rates come down. So if we had this conversation yesterday, it'd be a good conversation because the 10-year dropped 10 basis points. So we went from, call it 4.3 to 4.2. That's probably a $3,000 worth of cost on a $400,000 loan. So it's substantial.
It's a big deal.
Yeah, for sure. I mean, like the thing is when people see the headlines, oh, mortgage rates tumbled. I mean, yeah. I mean, are we talking about we tripped, or we're going down the face of the mountain? We're definitely not going down the face of the mountain.
Yeah.
Thursdays. I mean, if you look compared to yesterday, we've basically given all that back. The gain we got is back. Pretty much. So 10 bips down yesterday, 8 bips up today, 8 basis points. So it is what it is.
And then what's next? What's the next big indicator from the Fed? Is it a report on inflation?
Yeah. So tomorrow's inflation. I mean, that's the big driver, CPI. The Fed's going to use that to see kind of the health of the economy, that sort of thing. But yeah, and again, inflation goes up, rates go up, inflation comes down, rates come down. So it's, the biggest way, the way I like to think about it is just rates in general staying in a range. Mm-hmm. And so hopefully that range is kind of like this and not like falling off the map. I mean, we want rates to come down, but rates crashing down produces bad things.
Yeah.
Ultimately.
It means we're not in a good situation.
Yeah. I mean, if there's something that, all of a sudden you go from a 7 on average, I think conventional somewhere between 6.75 and 7 and an eighth, depending on your credit. Right. So let's say we're at 7 and all of a sudden we wake up tomorrow and rates are, 6. Yeah. That's a substantial, massive move, and something probably really bad happened. Again, like we do our, on our YouTube channel and, Instagram and TikTok, bad news in the economy typically means good news for rates, right? And so keeping that in mind, I mean, there's just no crystal ball in this stuff, man. It's just, there's too many moving parts. The market is very reactionary. So I think over time we'll see rates be better. What does that look like? It's not going to look like 3.5, but no. It's going to look, it's going to look better in the future,
Yeah.
Just kind of waiting that out. I mean, there's some things like if you look at the current administration, what they're trying to do, really just they're trying to outpace inflation with revenue. That's why the whole tariff thing is kind of what it's about. So, you have to have some level of healthy inflation. And the Fed says it's 2%, right? That's what they say. 3, 4, 5 is elevated and bad. So the thought is from the new administration is that, hey, look, we're going to out revenue in it. We're going to assign tariffs. We're going to force corporations to come into the US and build their product. I mean, like Apple made $500 million investment to bring some manufacturing, I believe, over to the United States. That's good, right? Like it's good for the economy. It's going to be jobs. So that's the idea of just, hey, cut everything to the bone and hopefully inflation comes down, which isn't great because you still got the other side of that coin is you got GDP. So if you crush growth, that's recession, right?
Yep.
So you gotta look, I don't envy them.
Yeah, I would say one of the other things we battle is obviously these news outlets are looking for clicks and eyeballs. So, the smallest movement in rates gets this headline, rates tumble, as you said, and rates aren't tumbling. They're moving in very small increments. And, we have customers that'll reach out and check on a daily basis expecting, half a basis point movement. We're just not going to see that. I think, we're still dealing here in California. We're still dealing with the freeze-in effect of the low interest rates and people not wanting to do anything because they feel the high sixes, low sevens is still too high.
Yep.
If those people are sitting on, debt outside of their home, it's probably a very good time to borrow against your house and take care of that debt. So yeah, it's an interesting time. I think we're seeing a lot of people still on the sidelines, scared to borrow money, still seeing a lot of cash deals here. But yeah, it's just hard to say that, in 2 quarters, we're going to be sitting high fives. There's just no guarantee. The news cycles are going to continue to do what they do, and the facts will remain. What the 10-year does is what rates do, and we'll have to continue to ride that out. It's not like we're not writing loans. We're still seeing a decent amount of production and decent amount of activity. I think it's the people on the sidelines that are waiting for the cliff, and the cliff isn't there.
Yeah, so let me put it in perspective as far as deal flow looks like. Typically the last 3 years, we were about 15% refis, right? Obvious reasons. Today, 47% refinance business right now. So, you got the folks like you talked about, they're using the My Home IQ home wealth report that
tracking everything
from us. They're tracking, they're looking at their current, kind of that, revolving debt, i.e. credit cards at 20, 25, 28%. You're never going to get ahead of that.
No.
That makes sense. In certain situations, we're seeing a lot of folks that are doing home improvement projects. They're trying to build more value into their home. They're using the current equity to build it up more. Yeah, I mean, we're definitely seeing a shift in 2025 to consumers and how they're accessing that cash. And frankly, rates are more palatable, right? Like 7.5, 7.75 to do a cash out, call it a year ago, probably wasn't a fun experience. Today, 6.75, 7, you can bite that bullet a little bit.
Especially when you're eliminating 23 to 30% interest rate debt on the other end.
Yeah, because it's, you make the minimum payment, you're doing that for 25 years. You're not getting ahead of it. So yeah, I think it's definitely an interesting market. I was having a conversation today with a real estate broker, and just how different this year feels. I think a lot of people thought with the new administration and things, I think people are still in a kind of wait and see mode for the most part. But I mean, the pipeline, as far as we are concerned, is almost as high as it's ever been. And so there's deals out there. They're just different clients. We're having to be way more creative, whether it's bank statements, 1099s, investor products. So, I mean, that's the great thing about Pure Funding, is having those access to a wide array of products so you can get deals done.
Yeah, and I think that's a good point. I just actually had a call earlier today. He had kind of run his need past one of the big banks, and they gave him one straight answer, and that answer wasn't good. And he asked me, like, what's the difference? Why am I going to hear anything different from you guys? And it's like, well, we're a broker. So we have a network of lenders that we go to. Those lenders all have different investors with different appetites for risk, right? So the same scenario we price with one lender is not going to be the same at the next lender. So it gives us more options and more cards to play when we talk about customer needs. So
yeah,
we're not going to put a calculator in front of you and say that number is the only number you're going to see. No, we have options to go around and figure out different ways to go about this.
Yeah. I think the crazy, it's just like yesterday I was looking through some of the investors and somebody was looking for a bank statement HELOC loan, and I knew we had them, but I hasn't really been a huge need, but it's there. If you don't, your tax returns, if you're doing what your CPA wants you to do and you're not paying a ton back to the government and you're taking advantage of the tax code and writing a lot of things off, we've got an option for you there. It's pretty crazy. It really is interesting how different coming from the retail. We spent a lot of time in the retail space just doing straight kind of vanilla conventional FHA VA loans, and really what is out there from a product set for consumers to get deals done. It really is it's pretty cool.
I feel like there's something new coming across our desk every week, if not every day.
Yeah.
Like if that scenario, right? The bank statement HELOC. Yeah, we just got to go find it. Like we have a healthy network of lenders, and by the way, they want business too. So, like they're getting creative and they're getting aggressive. Like we are in your corner to go find the most competitive option and the option that makes the most sense for your current situation. Yeah. So, I think it's a differentiator. We probably do not spend enough time talking about. I mean, everybody just puts us in the even realtors like, Clark's a lender. Like, we're a lender, but we're a little different in how we work. And we have a number of different ways to go about solving the problem. So, all right, Gary, well, that's a good update. We will continue to do these as we move through the year, and hopefully we get on somewhat of a slight ski hill down, but it will remain to be seen.
We're on the we're heading to the bunny hill. We're getting ready to just kind of, and we have been. But we're still higher than we were in the fall. So we got to get back down there, and that'll be kind of the next consolidation of kind of the market to see what it's going to do, if it's going to break through that and go down, or if it's going to stay up. But TBD, get that crystal ball out. We can go win
get that crystal ball, buy those lotto tickets, solve all the problems.
Exactly.
All this goes away with one ticket.
One ticket.
All right. Well, thanks, Gary. Thanks for taking the time. Thanks, everybody, for tuning in. We'll be back we got some pretty cool content we're working on, so we'll be back again here shortly. Have a great day, everyone.
See y'all.
See ya.